What's going on, guys? Welcome to another video. In this one, as I promised in my public Telegram group, it's going to be about the market maker models. Okay. Now, before we start getting into it, we are not going to have a Notion presentation. We're going to just dive deep into this. All right. And I want to tell you guys one thing: 90-minute cycles don't exist. 90-minute cycles don't exist. Okay. You can use 90-minute cycles to get certain data points. Okay, you can use it to get certain data points. But saying that there are concepts that can be traded, in terms of liquidity to liquidity is a false statement. Now, the reason I'm saying this is because everyone just takes it as it goes, right, from ICT itself himself. But as of recent, what has he said? He has said that 90-minute cycles are only a thing that he mentioned in passing, and the actual thing is 1 hour delivery cycles, which is consistent with CLS price delivery, as I have discovered 4 years ago. 3 years ago, sorry, 3 years ago. Okay. So now, having said that, in order to understand market maker models, you all know that I made 2 videos about this, and each video just gets better than the last. Okay. A market maker model is how price books every single time, right? If you see this move down here, that's a market maker model. If you see this move back up, that's a market maker model. This move back down is a market maker model, right? But the only problem, or rather the only question that you'll have is you'll be like, okay, fine, if this move down is a market maker model, why are we not taking out the low? But why are we taking out the high? Right. That is because you will be combining this information with the power of 6. Okay. You guys know the power of 6, right? So, first of all, to really understand the market maker model, you must understand SMT divergence, and not just any SMT divergence, right? You must have SMT divergence with the price leg, that you want to trade against. So what does that mean? It means that if you have, let's say, an SMT divergence like so, okay, you have something like this, then the market maker model is going to be from this high up until this low. Okay, from this high up until this low. So if you want to take part in large price swings, it would be useful if you already have a larger SMT followed by a small SMT, because the smaller one is going to give you additional confirmation, right? And once you have this SMT divergence, right, then and only then will you be focusing on the fractal approach. And what is that fractal approach? It's this. Fractal approach would be, okay, we're taking the smart money reversal, breaker, redistribution 1, redistribution 2, TP. So TP would be that low, right? But if you have been following my work for some time, you will know that if you take the original price swing that made the high, and if you project 3 to 5 standard deviations, price is not going to only stop over here. It will go for that additional stop run at either 3 standard deviations or 5 standard deviations in this case to form the low of that fractal time interval. Okay, let's take a look at an example. So right now on Bitcoin, okay, you can see I'm in a position there. What is this? Well, first of all, this is a continuation profile. I can't get into it. It's my mentorship stuff. It's a continuation profile. Okay. The SMT divergence between Ethereum and Bitcoin is here. Okay. So now, when you see price creating the first ever PD array in the PD array matrix, that is when you know that a market maker model has begun. What do I mean by this? Now, of course, you guys know that the PD array matrix is as follows, right? So it is mitigation block, breaker, liquidity void, FEG and its variance, right? Order block, rejection block, high low. Okay, so you want price to create these POIs as it's moving, and then only you'll know that, wow, something is happening. We are in a market maker model. And every single day, every single price swing based on the SMT that you are seeing, there is a market maker model. There is a market maker model. Okay. So take this into consideration. See this here? Right here. See that we created a rejection block. And then what happened? We used that rejection block right here. See that? We used that rejection block. So that now becomes a breaker. Why? A breaker is a failed order block, a failed variation of an order block. So that is what? This. That's your breaker. Okay. Now, inside of this price range, there was also SMT divergence between these two highs. So yesterday in the PM session, there was a sell, a market maker sell model happening inside of this range right here. So if you take a look, if it's on the 5-minute chart, you have to go to the 15-second, 30-second, maybe even the 1 minute. So let's go to the 1 minute. And we're waiting for price to create a breaker or create something from the PDRA matrix. Okay. So what do we have? In this case, we have this order block. Price reacts from the order block, as you can see by the up close candle. So if we trade through the order block, it becomes a breaker. And you can use to sell. Okay. And because this is the highest high, that one, that's the highest high. Will we close below this? No. So I'm looking at structure that price will close below. There. So I'm taking this low, this high. And this is my projected take profit. It's not the projected low, it's a projected take profit. Okay. Watch now. I'm looking for price to use the breaker. If it's too far gone, I will use this inversion fair value gap. There you go, inversion fair value gap. And now you can take a short to go for that low. If you get the breaker, that's even better, but you can see price open down here. And did we hit? Did we hit? We did. Okay, yeah, we did. We hit right there. And that's a market maker model. So if you understand the depth of just how important SMT divergence is, this will get really easy for you. You can trade any price swing. Okay, you can literally trade any price swing. So over here, what you're seeing right here, right here, we have an SMT divergence. Okay, we have an SMT divergence. See that? This red line here. Yeah. So in this case, for this session, that market maker model is going to be for this low. Yeah. And then if you can aggressively trade down, then we're going to go to at least the 75% of this price range. Here. Okay, you can come here. Why? Now you see, if every price swing is a market maker model, okay, you will also see that price sometimes stops internally, right? So here we go up, come down, we stop. Go up, come down, we stop. Right? That's because these are close to the 75% points of the range, 75% valuation of the range. The 75% valuation of any price range is a natural stopping point for a market maker model. Wow. People are charging you for this bullshit, bro. It's not bullshit. It's not bullshit. It's really good shit, right? Price is naturally going to stop at the 75% valuation point of any price range as a market maker model terminus point. People literally charge for this. Holy shit. Okay. That. Now, what if we were to add the power of 6? Huh? What if we were to add the power of 6? Now, what you're seeing here, right? around, I believe it was around here, we have an SMT divergence. Yes, we do. We have an SMT divergence here. So right now we are working with this entire price range, no? We're working with this entire price range. And that 75% is a natural stopping point. So are we in a market maker buy model? Going up, going high. Are we working in a market maker buy model? It's hard to say. Why? Because we need to see what's happening here. Are we moving down instead of moving up? Maybe this is just a temporary reversal because price has reached the 75% of this entire range. Can you see that? See, if you look at this, okay, let's take the high time frame. On the high time frame, do we have SMT? Look. No, yeah, we do. We have SMT right there. See, high, lower high. So there is an SMT divergence at the highs, right? And that is making this our focal attention, our focal point of attention. And that focal point of attention would be the lowest range here. This lowest range right here. From this low to this side. That's our attention now. That's where attention is going to be. Because that is your potential market maker model. But how do I confirm that this is indeed a market maker model? We want price to create the POIs, right? So what? So over here, where's the break? Right here, as we're trading down, where's the break? Can you see? No, we have no break. But what do we have instead that price is actually using? Right. What do we have instead that price is actually using? An inversion gap. There. Okay. Followed by this. See, here we have order block becomes a rejection block. Price uses it and goes higher, right? So this is our mitigation block there. So if price can use this mitigation block and start to trade lower, then we are going to take out this low. Okay. Now we understood that the smart money reversal happened up over here, right? So there is no proper mitigation, so to speak, of any price range. Okay, there is no mitigation of any price range. In fact, the only thing that resembles the mitigation of any price range is here, as per this reaction. So if you take this low to this high, this here is your projected low for this market maker model that's occurring right now. Okay, that's the projected low. And if you take this 5 standard deviations, that's your guaranteed low. Okay, so it's very important to understand stuff like this. Keep it simple because we are for the most part we're all scalpers, we're all day traders. Use the 1 hour, use the 4 hour, and then you can gauge your market maker models like that, and you can combine it with the bias predictions. Okay, so for example, in today's London session bias prediction for Bitcoin, right? For today's bias prediction for Bitcoin, what we are facing, okay, what we are facing is we are facing a bullish Bitcoin, but we have another 20 minutes, and if price trades below this low and closes down there, Bitcoin has finalized its bias into a bearish bias. And that bearish bias will then help us to say that, oh, wow, okay, we're going to trade low and we're going to hit take profit for sure. Okay, so once you see this, you can't unsee it, because that's the market maker model, while a fractal market maker sell model happening here, while a larger market maker sell model is occurring. Okay, so it depends on time, it depends on the weekly profile that will determine just how far it's going to go. Okay, so as you can see, every turning point has an SMT. This one here, there's an SMT which caused price to go up. Up there, we had an SMT which caused price to go down. Here we have an SMT which is going to cause price to go down. Here we have an SMT that's going to cause price to go down. Okay, so remember, when it comes to the market maker models, here's the sequence. SMT, sequential PD array creation, usage of PD array with proper body closure. Okay, then you'll use the original swing for high-low projection. Okay, now that brings me to my next point. The next point is, how do I know when the market maker model is going to happen? That is when power of 6 comes into play, right? Accumulation, manipulation, distribution. Accumulation, manipulation, distribution. So we have accumulation, this also becomes accumulation. Manipulation, okay, it happened. Distribution, this is also distribution, and in between there is manipulation. This is time distortion, right? So these three intervals, they're the perfect ones for expansions. And you want to avoid accumulation on both sides. This is your magic intervals of the day. Now, if you take into consideration what happened yesterday. So yesterday, take yesterday's price action. We're taking 6 o'clock to 6 o'clock. I don't know why this is being a bit of a pain, but you know what, let's just keep it here. Okay. What do we have here? Well, I saw that there was SMT right there, right? That was SMT right there. So that's manipulation. But the day always starts with accumulation or manipulation, right? The day starts with always accumulation or manipulation. So in this case, okay, in this case, here, where I'm putting my cursor, there is an SMT divergence with Ethereum. Bitcoin makes a higher high, Ethereum makes a lower high. So this is manipulation. This is distribution, right? So in this case, if this is your SMT divergence, this is the scope of your market maker model. Anything extra is just going to give us the low of that projection. So let me just write this down. Manipulation, distribution, manipulation, accumulation, distribution, AMD. What's over here? A. So you want to trade this. You want to trade this. And you want to trade this too. Why this? Why this? Because we are distributing, and when price finishes the accumulation, it will resume. Okay, when price finishes the accumulation, it will resume. Whenever price finishes its accumulation phase, it will resume. What is an accumulation? A natural retracement. When it's done with the retracement, price will resume. Okay, once the accumulation is done and price triggers another buy model, in this case, then the accumulation is done. Okay, so how do I get the projected high now? Well, the projected high, I mean, the high that we formed was up over here. Okay, high that we formed was up over here. The highest high formed in this price range, right, that got mitigated is this. This up close to this point right here. 2 standard deviations, we got it. But we are not looking for 2 standard deviations. So how do I make this? How do I fix this so that it will come to 3 standard deviations? I will use a proper structure point that got mitigated. So that is where the one associated with the SMT divergence here. Okay, this swing low made that swing high. See that? Okay, that is going to give me the projected low here. That's my target. Goes a bit more, that's okay. And then from that point onwards, we're looking for the reversal. Likewise, once we're done with this accumulation, once we begin another buy program, right? I'm looking at the structure that got validated. So this one, I'm going to find the terminus. 3 standard deviations there. My buy over here is going to finish off at this 3 standard deviations. Okay, so remember, If I were to draw it for you, it is basically this. This is what the higher time frame looks like. Okay. This is what the higher time frame looks like. And this is what the lower time frame looks like. So let's say here you form a bullish order block, react from the bullish order block, make a new high, fail the bullish order block, this becomes a bearish breaker, inversion fair value gap, and then take off. That's your market maker model. It happens every single day. Okay, happens every single day. Now, let's say now I said we are going to solidify our bias in another 20 minutes, but now it's another 10 minutes left. So if my bullish bias for the London session were to work out in this case, okay, if the bullish bias for the London session were to work out for me in this case, I need to have S&P divergence, right? But can I have S&P divergence right now? No, because relative to the opening price at 1 o'clock, we have S&P divergence here also. So you see how it's just giving you opportunity upon opportunity upon opportunity there. And the market maker model now in this case was here. See this. This. See that. Look at the 30-second chart. It's a bit ugly, but okay. See this. Can you see the swing low, down close? This becomes a breaker, this entire thing. Price uses the breaker and sells off immediately. There. You can use it as a scalp. Okay. Now, when you truly understand this, and let's say now you want to apply the bullish bias. Okay. We understand then that bullish bias will only be counter trend. Okay. If say it comes here and at around 4 o'clock or 5 o'clock, you want to buy, depending on where price is, it'll trigger a buy model, and you can take that buy model until wherever, either here or over here, and then get that continuation back down. Okay. So it's very vital that you understand it. And please, I don't know why the hell you guys are paying for shit like this. Simply you can ask me. I'll give you the most in-depth ICT concept videos ever without charging. Only thing I'll charge you for is my own concepts. But this is the easiest shit ever. Yes, it takes a bit of thinking, but this is the easiest shit ever. Okay. So I hope you found this insightful. And if you have any questions, you can definitely ask me on Telegram, or you can you can just put a comment down in the comment section below. And that's all. I'll see you in the next one. Be sure to like, comment, and subscribe. Good luck and good trading. Bye-bye.